right, good afternoon. My name is Ben Shoesmith. I'm a senior economist with KPMG, and I'm absolutely delighted to be with you today, really for two reasons. The first is that just this week I've actually had the opportunity now to hear from two FOMC members. The first was Fed Chair Powell out in Nashville on Monday, and the second was obviously President Barkin just a moment ago. And so for me, I think that's going to be a personal record for the rest of my life, 3 in 2 days. Probably will never happen again. And the second reason is that I went to UNC Wilmington, graduated a decade ago. Dean Burris was my thesis advisor, and I heard about this conference all the time. Never had the opportunity to attend, and so being here today, it feels like a full circle moment. And so I'm really appreciative for that. Now, we've heard about the United States economy. That's one country down. We have 194 to go. And so let's go ahead and jump right in. If we can move over to the slides, please. We're going to start with an overview of the global economy, looking at different leaders and laggards moving to monetary policy, touch on geopolitical risk, trade, and finish with headwinds and tailwinds. And so we're going to start here with contributions to global GDP growth. This is our forecast from KPMG. Came out in September, so it's a little bit dated. We'll be updating it later on this month. And what we're going to do is look at first the trend and then jump into which regions we think are going to outperform and which are going to underperform. So I'd like to start by saying we're forecasting what would effectively be a global softish landing. It's not going to be this boomy economy we've seen in the past. Actually, growth is a little bit slower than it was pre-pandemic. But we're expecting to see growth in this year to be equal to last year, 3.1% roughly, a decline to 2.9% in 2025, and then a rebound to 3.3% in 2026. The decline is going to be due in part to the lagged effects from monetary policy that's been taking place around the world, as we'll see on the next slide. But then we're hoping that with these reduced rates, we'll see a resurgence of investment and the consumer going into 2026. Now, in terms of which economies are underperforming, we'll call those the laggards. We're going to start with Europe, formerly the powerhouse of the world. It's been a while since they were in that position, but they're really struggling right now. In fact, Germany, the manufacturing engine of Europe, has been in a position where it's been teetering on, flirting with the line of being in a technical recession, which would be 2 consecutive quarters of negative real growth. And what initially started this was first the pandemic, but then the Russia-Ukraine conflict pushed up energy costs, caused a number of manufacturing firms to close down, or at least pause production, and growth slowed. Now, those energy pressures have gone away, which is fantastic, but simultaneously, we've actually seen declining demand coming from China, which was alluded to a moment ago by President Barkin. And with this weaker demand being one of the largest trading partners of Germany, we're seeing the German economy really suffering. Now, you flip the page over and you look at the other side of Germany, the southern economies of Germany, those that formerly really struggled, the GIPS countries, Greece, Italy, Spain, they've actually been outperforming as of late. A huge influx of tourism, not always welcomed by local residents, has been driving a lot of their growth. It looks like some of that will be sticky and remain going forward. But Southern Europe is now really the driver, which is historically a little bit peculiar. The next laggard we're going to discuss is going to be the Middle East. Now, lower oil prices are fantastic for us. It's not great for oil producers. And so these prices that we're seeing per barrel, $70 as of, I think, 15 minutes ago, $70 on WTI, $75, $74 on Brent, is really causing stress on the output of countries like Saudi Arabia and Kuwait. Now, this is not just due to weak demand coming from China. We also, I think, in my opinion, maybe some underpriced risk coming from the conflict in the Middle East that we'll talk about in a moment when we get to geopolitical pressures. But for now, assuming that oil prices stay where they are in that low $70 range, we would assume that the Middle East would be a laggard. And so then let's turn our attention now to the leaders. So we're going to start with South America. It's going to be the green bars at the very top. They're going to be the smallest, but they're growing going into 2026. And what is happening here, at least from what we can tell, is that Latin America was among the first central banks to really jump into the fray. Latin America had the first central banks to jump into the fray, hiking rates very rapidly. Initially in 2021, several months or quarters even before the Federal Reserve jumped in. And so they took a jump on inflation. Now, they also, because they decided to head off faster, were able to start cutting more sooner. Now, Brazil has been sort of the leader here. They're the impetus behind this growth. And it's not always so welcome, particularly in that country, because when rates started coming down, Brazilians started spending more. Wages were still very strong, and that actually caused a resurgence in inflation. And so while every other central bank in the region is still cutting, while the Fed has now entered the fray with 50 basis points, the ECB, the BOE, the Bank of Canada, we'll see in the next slide, are also cutting. The Central Bank of Brazil has had to reverse course and is now raising rates. They have some independence issues with their government, which is a real concern for going forward. But for now, we still think that even with these rate hikes coming from Brazil, they'll still see additional growth that they wouldn't have seen otherwise. Which then leaves us with Asia, the most dynamic region in the world, the one that I get most excited about. I'm actually headed there on Saturday to Singapore and Hong Kong for about a week and a half to speak with clients. And while there is a slight dip in their contribution, they still make up more than 50% of the world's growth, which is just absolutely phenomenal, especially when you consider that Chinese demand has been weak. KPMG, China's forecast for growth in the country has actually slipped from 5% this year to 4.5% next year and 4.5% in 2026. And so while China's sliding down, there are other countries that are picking up the slack. And those countries are, of course, India, Malaysia, India, Malaysia, Indonesia, Vietnam. And a couple of these have been of particular interest, especially when we talk about the friend-shoring initiatives that have been taking place in the United States. And so India, 8.7% growth last year. Oh my gosh, that's just absolutely fantastic. We don't expect to see that going forward. We actually think it's going to slow a little bit, maybe into the low sixes this year. But where there's a lot of hope is actually in some of the other islandish countries. Think Indonesia, projected by 2050 by Goldman Sachs to be the world's 6th largest economy. And then India is actually supposed to perform well enough to pass Japan and Germany to become the world's 3rd largest economy by 2030. That's just a few years away. And so when we look at Asia, it is dynamic, it has different growth patterns, a very young population, increasingly educated in STEM subjects, and we think there's a lot of potential here. And we're not alone. I think most economists would probably agree that this is the region that has the most opportunity in front of it, but we think that Asia is actually going to be able to capture that because of the new trade environment that we've been entering over the last several years. Now, I mentioned the Central Bank of Brazil, emerging markets, especially in Latin America, raising rates a moment ago, and so I want to talk now about major central banks. So we're looking at, I know the type is kind of small here, but the Bank of Japan, the Federal Reserve, the Bank of England, the European Central Bank, and the Bank of Canada. Now, the Bank of Canada, the last one, they're going to be, obviously our neighbor to the north has actually done 3 25 basis point rate cuts over the last 3 meetings that they've had. Now, that's the fastest cutting of any major central bank. It's because they've been having a struggle, their housing market's been struggling a little bit. Whereas in the United States, we have 30-year fixed-rate mortgages as being the preferred form of getting a home. In Canada, they have more of a 5-year variable rate mortgage structure that resets pretty frequently. And so when you have high interest rates, your economy starts to slow down, especially when it's eating into disposable income for your citizens. And so Canada's been rapidly cutting. Bank of England, ECB, they're cutting as well, but much more cautiously. Sticky services inflation has been a problem around the world. The United States has wage growth has been very strong, fantastic for the people who are receiving it, but it does feed through to prices. We've also seen, as alluded to a moment ago as well, higher insurance costs, higher rents for homes, and so all of these contribute to high services costs, which makes those, at least in the United States, has been sticky. But it's not just been here, it's actually fed over to Europe, and it's fed over again to not just the EU, but England as well. And so they're very cautious. We expect more cuts coming this year, but they're going to be at a much slower clip than we'd see probably even in the United States. And then we go down to the Bank of Japan. They're going to be the purple line at the bottom that's rising. They're the only major central bank in the world that's increasing rates. They have high, strong wage growth for the first time in quite a while. The consumer is starting to show some signs of resurgence. Their GDP is looking good for the first time in a while. Inflation's finally headed toward their target of 2%, but it is still needs to be brought back into line at 2. You'll see that it was actually negative for quite some time as well. And that was because their inflation was so low, the central bank was trying to stimulate, so they pushed rates into negative territory. Now, the Fed did hit the zero lower bound for 2012 to 2018 or so, in an effect to stimulate, but they never had to go into negative territory. Japan has, but they're now coming back. So when we think about going forward into the next year, yes, lower rates are going to be fantastic. They will be stimulative. But the lagged effects of monetary policy, at least in the U.S., they can take between 12 and 24 months. No one can really nail down the exact answer, but somewhere in there, 12 to 24 months between the time the Fed makes a decision to when it actually comes through in the real economy. And so it takes some time to work through, which means that we won't see these effects directly in the real economy for quite some time. And the same will be said around the world, although they do have different lag structures. So while 2025 may be a little bit weaker, 2026 should be fairly strong. And so that's why our forecast said on the previous slide that we're going to see this growth back to 3.3% in 2026. Now, we've talked about growth, we've talked a little bit about inflation, we've talked about monetary policy. All very important topics. But what our group focuses on pretty frequently is what happens with risk. Because after all, when I look at economics, when I look at finance, the key to all of this is risk management. In my career, I've actually worked in operational risk, credit risk, interest rate risk, foreign exchange risk. Now I get to work in economic risk. And so I touch this at every single phase of my professional career thus far. And so right now, let's look at geopolitical risk. Between 2019 and 1985, the average is 100. That's going to be that dotted red line. You can see that we are elevated about 33% above that line right now. So we're not in a great situation. There is risk on the table, and when we talk about oil, I don't think it's being properly accounted for. We had the Russia-Ukraine war, the initial spike. People became used to it. It got baked into forecasts. I think there was a little bit of, it's here to stay, and so let's not really think about it a lot more. You don't see it in headlines quite nearly as often as you did initially in the conflict. And then we had October 7th, the Middle East conflict begins, and you see geopolitical risk start to rise again. It still is rising. But as it's rising, we've actually seen oil prices fall. Within the last year, they were up in the 85% range per barrel. Today, they're at $74 a barrel, as I just mentioned a moment ago. But just last week, they were in the low 70s. WTI was at $68 a barrel. And this is while there's a conflict brewing in the Middle East, a tinderbox, as our team calls it, that has the opportunity to spread out beyond into the broader region and affect global oil supply, which would obviously be detrimental to oil prices. So while this is good for the consumer, lower oil prices are great. If the risk isn't properly being priced in, you have much higher chance of volatility when it does finally come to bear. We did a little bit of analysis around this several months ago. We looked at what would happen if the Strait of Hormuz, which is a 21-mile stretch of water, or 21-mile wide stretch of water, where 20% of the world's seaborne oil flows, were to become blocked off. And if that were to occur, you would actually see oil prices go up to about the $140 a barrel range, double from where they are today. Growth would slow pretty substantially, down about 1%, inflation up about 1.5%. And then that would cause central banks around the world, not just in the United States, to have to re-raise rates to tame that inflation once again. And so when we think about risk, we need to be holistic. We need to think about the tail events as well, because as the tails get fatter, they become a little bit more likely. And so while trade is not exactly a risk, it's related to geopolitical risk. And so this is the share of U.S. imports by trading partner. You'll notice that in Q4 2019, China was our largest trading partner, about 14% of imports coming from the country. That has since declined down to about 11%, and the number one spot has now been claimed by Mexico. Number two is Canada. The USMCA agreement has been fantastic. It's going to be renegotiated in 2026, but there is a clause in there, a sunset clause. It says if an agreement is not reached by 2036, the USMCA will be phased out. And so, not to put concern in everyone's eyes, but it is another risk to consider. And so, we do think about that a lot as a team, especially because a lot of our clients sit in the Americas, particularly in Mexico and Canada. But what I think is most important about this chart is actually what's at the very backside: South Korea, India, and Vietnam. Southeast Asian, Asian countries, really Southeast Asian, East Asian, and South Asian countries, that have all been huge beneficiaries of this shifting of global trade, of U.S. trade. Vietnam in particular, I want to point out. So this is a burgeoning manufacturing destination. They're actually moving up the value chain right now. They, for years, have been able to manufacture textiles just fine. But as of late, they're starting to get more intense products. They're getting some lower-end chips. They're starting to get more machinery to produce. And so they're really starting to open up to the world and become much more of a major exporter, especially to the United States. But if a tariff of, say, 10%, broad global tariff were to be placed on Vietnam, it would be horribly detrimental to their exports, and it would stall out their economy for quite some time until they can figure out a new trading partner to take all the manufacturing capacity that they have been building up in the last few years. And so I want to finish here looking at headwinds, tailwinds, and risks at the long-term and short-term level. I made the darker shades being short-term, as in a little bit more immediate, lighter shades indicating that they are somewhat out in the future. But I want to focus, because I don't have very much time, into these that we've boxed here. So supply chain reorganization hits both the headwind and the tailwind, because in terms of tailwinds, it's going to make supply chains much more resilient. Right? If you have a single node supply chain and a lot of sectors are sourcing their products from this one country, and I don't want to say a pandemic hits, then all of a sudden supply chains get backed up and knocked off, and it's very challenging to get product into the United States, into the consumer's hands. But if you spread that risk out, it's like diversification in finance, your portfolio is a little bit more safe. And so when you see the friend-shoring, reshoring, nearshoring initiatives, these help build more resilient supply chains. But on the other side of the coin, they're expensive. You're not getting the lowest cost producer, and they take a long time to develop. And so it's also a headwind. And so when we think about supply chain organization, it really is, what is the firm trying to accomplish here? Do they want to get the cheapest product? Is that their main goal? Or are they more concerned with what happens in the off chance that tail event strikes and they're not able to actually reach their producers? Now, post-election policy changes are obviously top of mind of most clients, whether we're talking about tax policy, trade policy, immigration policy. And so this is something that we can discuss during Q&A if you'd like. But then oil shocks we've already talked about, and cyber attacks. This is not my area of expertise. It's something I'm just starting to dip my toe into. But what we found is actually that in our last KPMG CEO survey of large organizations, 500 million in revenue or more, they found that this is the number one concern of CEOs right now for 2025, cyber risk. And a third party has done some research and found that by 2027, I believe it is, they're predicting that $27 trillion worth of economic loss will take place due to cyber attacks, whether that's going to be due to ransomware, the insurance you have to pay, or whatever comes out of data leaks. And so cyber attacks, by the way, 27 trillion is roughly the size of the U.S. economy. So we're talking about a very large sum of economic loss. And then, I meant to say, last thing, and then I'll close out here. Post-election policy changes are top of mind of decision makers as well. Different KPMG CEO survey from March of this year actually said that 62% are delaying major capital investments and M&A until post-election. They want to know what the regulatory environment, the trade environment, the immigration environment looks like before they make any large decision. And obviously, then they were also waiting on the Federal Reserve to start lowering rates. And so we've cleared one hurdle. We have one more to clear. We're now down to, what is it now? A month and 3 days. And so it is right upon us. Hopefully, that's going to unleash a little bit more investment that will give us another tailwind heading into 2025 as we see that consumers start to slow down due to those lagged effects from monetary policy that I mentioned. So to sum all this up, the globe is in a pretty good place. Yes, there are regions that are struggling. Germany, a couple other countries in Europe. There is political uncertainty in some South American countries when you think about Ecuador and Colombia. But on the whole, we're not seeing a global recession like we would have seen during the great financial crisis. We expect to see, we're hoping to see rather, a softish landing, but we do think that the window for that to happen is actually starting to narrow. And so as central banks work on guiding their economies back down toward this soft landing, we are cautiously optimistic. Inflation is coming down. Consumers still appear to be strong across most economies, but there are risks that need to be considered and taken into account. And so at that NABE meeting, the National Association for Business Economics meeting in Nashville, one of the speakers talked extensively about scenario analysis and its importance. You can't just take your base case and assume this was going to happen. You need to think about what happens if you have better growth, worse growth, risk strikes in 2 months or 6 months, and how that will affect your supply chains, your consumers, and then their habits with you. And so with that, I look forward to your questions in just a few minutes. Thank you so much for your time.